For a larger buyer that might have a multiple of 13.5 times, and they're buying a selling agency at 12 times, there's an accretive value, 1.5 times EBITDA. Immediately, as soon as the acquisition happens, that EBITDA of the seller becomes the EBITDA of the buyer, and it becomes much more valuable or accretive to the buyer. So using two examples here, we have a transaction that's 100% cash financed, and we run that out over 3 years, even using the same EBITDA synergies, same tax rate, same market arbitrage of using a 13.5 times multiple. And you can see after 3 years, if you use all cash, you've got a internal rate of return of 19% and a 3-year cash on cash return of 1.7 times. If you use $2 of debt for every dollar of equity that you put into it, so you put, 7.7 million of your money into it, $15 million of debt on it, definitely cash flows from a debt perspective, but the internal rate of return at the end of those 3 years is 64%, and your cash on cash return of your initial investment of $7.7 million is 3 times. So this is really how the private equity model is built. And this is why you see private equity firms trading every 3 to 5 years, is they're looking for that 3 times cash on cash return. And almost everyone uses debt. We're using a 10% interest rate in this example, and it's still, even at that high rate, throws off a 3 times cash on cash return at the end of 3 years. So if we enter into a little bit of a lower interest rate environment, that could even happen quicker, or the returns could even be that much higher. But this chart really demonstrates the value of using debt in a transaction.